And welcome back into another live stream. This one is going to be super exciting. There's a question that I've been getting from hundreds of people. Where should I be investing in the market right now? We are at all-time highs. I want to be invested. I do not want to miss out. And like I like to say, all-time highs are not bearish. This is a good thing that we're up here. But at the same time, earnings season has not exactly shown that there is no risk in this market. PayPal absolutely slaughtered today out there. SoFi was up 17.5% and gave up the entire move by the end of the day. HIMS falling 7 to 10% as well, right? And so on and so forth. We've seen this across the board. So it's a little bit confusing for people because right now when you go and you look at the overall indices in this market, SPY was only down 0.25% today, right? QQQ was only down 0.12% today. What do these have in common? They're diversified. And so the key right now is where can you find diversification in key areas of the market that allow you to have upside while minimizing risk? And that's going to be a lot of what our conversation is going to focus around today. And of course, what better way to diversify than with actively managed ETFs? So we've got on the expert, the one and only Adam Patty, CEO and co-founder of VistaShares. I'm joined also by Evan and Sam, two awesome stalwarts of our spaces, and of course, awesome people on the timeline for you to check out. And we're going to walk through this topic, and we're going to kick it off in a minute talking about OMAH, which is the VistaShares Berkshire Target 15 Fund. But before we get into the ETF side of things, let's just hear a couple of comments on what I started us out with. Being at all-time highs and wanting to still have exposure to the market and doing it smartly. So before we talk ETFs, Adam, what's your thoughts off the rip?
Yeah, I mean, we live in interesting times, right? There's a lot of geopolitical risks, but what's interesting if you look at kind of the secular, kind of the cycles in the market, right? Traditionally, July and August are more volatile because trading volumes are going down. There's less investors; they're on vacation, right? So you do often see some selling pressure, towards the end of July into August. And what I'm seeing, and when I'm, talking to some of my trading buddies, who are, looking at the markets all day long and taking institutional orders, is they're seeing a little more of a pronounced selling pressure across some of the equity sectors. And what's interesting, and what investors I think really need to take into account is, when you buy a S&P 500 fund, you mentioned it, or Qs, you're buying that as a core equity holding because it's a diversified holding. But what's happened over the last several years is that they have become extremely over-concentrated in the Mag 7-ish type companies, right? Mag 7 plus other large tech companies. So
roughly 50% of the Qs is 10 companies.
Yeah, and the S&P isn't far off. So you're not getting the diversification you may have once gotten, right? You're getting a tech fund. And the Qs have always been the tech heavy NASDAQ, right? We get that, but I don't think most people think the S&P 500 is the tech heavy S&P 500, or at least not as tech heavy as it is today. So you need to look in other spots to get that diversification. And look, it's worked to now because we've been in a momentum driven market for the last 7 years, and momentum has really favored the big tech names. But as we know, markets go in cycles. There's many different factor tilts. Momentum is just one of them, and it's not, it cannot remain in a momentum market forever. It just historically doesn't happen. So you want to start looking at your portfolio and make sure you're diversified across different types of equities.
Beautifully said. Sam, would you like to bounce off that?
Yeah, I mean, it's good to have like a balanced portfolio. It just takes a lot of work to do it. I mean, let's be honest. The amount of effort that we all put in, Adam is a veteran in the space. He's been doing it for a long time. And I know you guys have been doing it too. It takes a lot of work to be on top of your companies that you own, read the earnings, listen to the conference calls, do cross-sector analysis, make sure valuations are checked and so on, trim certain things that when the valuation gets excessive, take it off when it gets done. Even to other people as well, including myself, sell covered calls against it, which is a strategy that Warren Buffett practices. And of course, we're going to talk about with the ETFs as well. it takes a lot of work to do that, and some people don't want to allocate the time to that, which rightfully so. In their case, you would like to invest in ETF. A lot of people buy the ETF every 2 weeks or however often they get their paycheck, and that's with the 401k, and it's automated for you. You can ask people exactly what they're buying in their 401k, and most of the time they'll tell you they really have no idea. In fact, they can't even tell you what the top holding in their 401k is, or let alone what NVIDIA is. I don't know. I don't know who is that case nowadays where they don't know what NVIDIA is, but a lot of people just generally, it's not like their foresight to be taking care of managing their portfolio on an active basis. Why not outsource that work and then buy into a fund? So, I think it's a well-balanced strategy to do that within your portfolio. And I do it as well with mine with a certain portion. But yeah, being at all-time highs, I have concentrated risk in a lot of the companies that I own, considering that there are a lot of momentum stocks. And one of the benefits of where we are today in terms of the bull market for the last 3 years was really the AI narrative, and AIS has seen phenomenal progress, up 26% year to date on that one. But a lot of people don't really know, how to rotate, what's the best position to rotate to in order to get the alpha, getting some covered calls and collecting some premium for that. People don't really know that. And I think it's great to get together with this to kind of explain that, especially with a few of the ETFs that VistaShares has.
Yeah. So speaking to these ETFs, we'll get to those, I suppose, in just 1 second. Evan, any comments before we get in?
No, I think they covered it well. I'm excited to hear what they have. We got a link. We got one comment, and it's from LinkedIn. That is so surprising. Look at
Big
Gav.
Cole Sweetman. Look
Honestly,
at that.
Gav, get this round of applause first. But no, I'm
Thank
excited for this conversation. I find the OMAH ETF concept to be very interesting. We've talked about that. There was a little bit of news around Buffett and one of the stocks that came out like yesterday or something with VeriSign. He's selling out a little bit of it. I think they were looking to sell out around 1/3 of their holdings. Now,
He's selling VeriSign?
Yeah, or
No wonder
still
it
holding
dumped.
2/3 of it. And look at like the 1 week chart on that one, and then you zoom out. Like there was a very large spike up coming into this, and then here we are today. So that was one of the big things that happened. But in general, like you're saying, the general thoughts of, hey, markets are here at all-time highs. I want to stay invested. But my time frame is 10 years plus. I have no problem staying invested in some of these names, and yeah, we'll see on certain things, but there's still some good opportunities, and maybe you let a cash pile build up. Maybe you buy something like maybe something that is in some other names that maybe haven't moved as much with a nice yield or something on it that you want to kind of play in this area. Anyone could do what they want, but I'm still slowly dollar cost averaging into these large indexes and picking up some names that I like along the way. There's been times where I build up positions in these kind of like yield names, and there's times when I maybe sell some of them. Maybe we talk about where we're at right now, but yeah,
Yeah, Adam.
I was going to say that's a great point because look, I mean, I would always caution people to stay invested, but to be diversified, right? I mean, look, we're talking about caution now, but then again, Goldman came out with some news. What was this morning? There's going to be 4 rate cuts this year, or I don't remember the 3. They said the rate cuts are going to be a lot more aggressive over the next 12 months. So the market could just go higher. So which is why you want to be invested, but you do want to be diversified because you want to control that downside. It's much harder to make up your returns if you take a huge drawdown. So you want to control that downside while retaining your upside potential.
Yeah, well put. There's a lot going on here. Yeah, VeriSign, shout out. Appreciate that dip. Maybe I'll add to that. All right, let's talk about the ETF here that we've been circling around a little bit, OMAH, and why I believe, and I can only speak to my personal items, and obviously I work together with Adam and VistaShares. So, take my insights with a grain of salt, but do listen to them, that this is a really interesting time period for this ETF. And I'm going
all right,
to
you know what, Gav? We are
case.
putting you on the spot right now.
Thank you.
No answer is not acceptable. All right, I want everyone to hear this. Go pull up that little ETF drop-down menu.
Pull up
this
the
is
ETF
just
drop-down.
Gav's thoughts. I want a favorite and a least favorite.
Gosh, well, I'm not going to give a least favorite. That doesn't.
No, you have to. I feel like, listen, that's the game.
I will rank them 1 to 4 with my level of confidence, and then I will ask Adam to do the same. No, I'm just kidding. Okay, so right now the leader for me and the one that like this is just levels of if I had $10,000 that I had to put into the market, the biggest chunks would go into one would be OMAH. And I'm going to explain why and give the thesis, but just running through my next two that would be kind of tied would be Wild and AIS. I'm a little torn and I want to explain why they're two. AIS, I think that the outperformance is amazing. You can just look at that chart. It has not slowed down at all. That sector has just been buoyed by NVIDIA and other names that should continue to run. I'm super bullish on AI. I believe that anything that creates the most valuable currency, which is time, which AI does for us, is going to have a huge growth boom over the next several years. Wild, though, holds names that are also related to that, right? It's got Palantir in there. It's got a couple of others. And then the only reason that I'm putting QUSA fourth, and we're going to talk about it because there's been all these creations for it, is just because for me, my investing comes with confidence. And
You don't like America? It's kind of gross.
oh my gosh. All right. Well, there you go. I knew he was going to come at me. My level of investing typically comes with my depth of understanding of something, because the deeper I understand it, the harder that I can commit to it. And that's where it usually just comes from. So let me just walk through real quick my thesis, and then others can talk to theirs. OMAH, why do I think this is so interesting right now? It's very interesting right now because of where the market is and because of where Berkshire Hathaway is. So I'm sharing this tab for a second just so people can see. The stock market has been on an absolute tear. This is QQQ over the last few years, right? We've just continued to run up and push to all-time highs. Here's SPY, similar type thing. When you go and you look at BRK.B, which is Berkshire right here, it also has had a big run up. But the only difference is over the last portion of this year, it's slowed down. And it's come back to a massive key moving average right here, which is this 50-day. This is a weekly. So 50 on the weekly moving average, which is huge. So to me, right, when I'm looking at stocks, it's always been more attractive to me to buy something at a pulled back to key moving average than it is to buy at all-time highs. Even though all-time highs are not bearish and statistically not a bad place to be buying, this chart to me is a little bit more attractive than one of the others. And so when I look at something like OMAH, right, and I'm saying, all right, I get access to essentially pretty much the same, a very similar, and I'll pull this out to a daily so we can have a little bit of a better look, a very similar level of holdings within this. But here's the thing. If I'm, let's say, buying in now at this moment, I'm not coming in at the top. I'm coming in on a very rare pullback for Berkshire, where I have confidence that this company can continue to move to the upside. I mean, look at this. This is like a 1% down day. And it's like, oh my gosh, what happened with Berkshire, right? This thing's not going to just go and crash. Like SPY very realistically can do this again. I mean, this happened and it happened fast. Berkshire during that same period, I mean, this was just boom. It just went right back up. I mean, this is literally like a week right here, right? This took like months, So there's a very big difference right there in what I'm looking at. But the piece is not only that. I'm buying something that has pulled back. So I'm not buying at all-time highs right now. I'm buying something that is diversified, right? Just like SPY and QQQ. So I don't have to worry about a massive crash. And even looking at this, it seems more diversified than those based on recent price action. And then number three, there is a covered call strategy being run on this. So let's say this just traverses sideways or slightly moves up, right? And it does 4 or 5% return over the next year. You're adding 15% on top of that in income. So to me, you kind of get this convergence of all these different areas that make this so interesting. So that's my case right there for OMAH. And I know we're going to go into QUSA in a second as well. And then we'll hit on the others because I am passionate, especially about the others. But to me, this is just such an interesting opportunity. And I am not the only one seeing it. I was looking on ETF Central, and I will wrap up my point with this and turn it to Adam. I was on ETF Central on my watch list, looking at OMAH. Look at that. 53 million last 5 days, 120 million last month. These are big boy numbers coming in. People are looking at this and saying, wow, this is an area that we feel pretty comfortable putting our money. So it's not just me. There's many others out here. I'm not alone on the fence here, but that's my thesis and not so hot take. What do you think, Adam?
I mean, I can't add anything to that. That was brilliant. I agree with everything. I mean, look, again, the SPY is very tech heavy. Look, if you go back to the beginning of the year, everyone was talking about how Berkshire was ripping, right? Berkshire was leading the market because if you remember, the market was unsteady. Trump had just been inaugurated. People didn't know what was going on about the tariffs. There was a flight to quality or to a value tilt. Again, I'm going to talk about tilts, and Berkshire is a value-oriented portfolio. So that was outperforming the market. Then the tariff tantrums happened. Everything got destroyed. Then there was euphoria, and all the tech companies came roaring back. So the SPY and the QQQ, they ripped higher and actually outperformed everything else because it was overdone and there was a lot of euphoria around the tech stocks. Berkshire has lagged because, again, we snapped right back into this momentum market. But to your point, that's when you want to buy, right? You want to buy when you want to buy low, hopefully, right? So, Berkshire is a value-oriented portfolio. It's 21 securities. It's Berkshire B and the top 20 publicly traded holdings of Berkshire Hathaway. It's the financial services. It's it's Visa. It's MasterCard. It's Bank of America. It's Citigroup. And then you got consumer products. You got Coca-Cola. You got Kroger, and you've got some other big name companies in there. And those are the companies that are a little more defensive and they're a little better for volatile markets. And I'm not saying to replace your S&P 500 exposure with it. You don't want to do that. It's a complement. It's a complementary core equity holding. Because, again, if you're getting 30-40% of the SPY exposure in 10 names, all 10 of which are probably tech names at this point, you want to have some other bigger, allocations to companies like a Coca-Cola, companies like that, like a Procter and Gamble. Companies that are going to be a little more defensive. And, that's how Berkshire has grown up, right? That's why Warren Buffett is the best investor ever. And Greg Abel has been there for 20 years. He's been running the portfolio for 3 or 4 years at this point. I don't see much, there's going to be a lot of wholesale changes in their strategy.
Very nice. Sam?
Can I actually ask one question on that? Because I think adding Berkshire B, the actual stock in this, changes the dynamic of it a little bit. Just the way it's kind of made up. Berkshire B, like there is the equity stocks, but then if you don't know, there's also $300-something billion of cash. There is also a lot of these other companies that they have, large insurance companies, Dairy Queen, etc., Fruit of the Loom. There's a bunch of others. So I think adding in that BRKB kind of does change the dynamic of this ETF as well, and adds a lot of other stuff. So I'm curious your thinking on this, not just being, hey, we're going to have the top 10 or top 15 Berkshire Hathaway holdings. Why also Berk B is in there?
Well, we want to have Berkshire B exposure. It's an incredible equity, right? I mean, and look, and part of it is we're also appealing to investors who really like to invest in Berkshire Hathaway directly. So, when we came up with this idea, part of it was, how do we add a synthetic dividend to Berkshire Hathaway exposure? So what we're giving investors is you could still have your Berkshire Hathaway, you could have their top 20 publicly traded holdings, and then you get your 15% annually, paid monthly, which you 1.25% per month, which we just paid out today again. So it's a well-diversified portfolio. And to your point, though, the equity holdings perform differently than Berkshire B will because of what you just said. They have $350 billion in cash. They've got all kinds of insurance payments going back and forth. It's a much more complicated company, and it performs differently than the straight equities.
Good question. Sam, you want to weigh in on this one at all?
Yeah, I mean, he didn't ask me. Thank you, Evan, for not putting me on the spot. So if I had $10 million and I wanted to put it in something, which I wish I did have $10 million and I wouldn't really have to worry about this. I hired someone to do it. But if I did, I'd probably allocate at this point in the market, not a large allocation to be overweight AIS. Sorry, not AIS, Wild, because it is the 2 times leverage ETF. And also a lot of it's focused on you had the recent rebalancing, you threw HIMS in there, Palantir in there, Tesla, and so on. Momentum is somewhat seeing a little bit of weakness at this point. So in order to be a bit strategic, I would want that allocation in it. But I would have a large allocation in AIS, even at today's levels, mostly because you have the leaders in what has been leading the market this whole time in the last 3 years in there, NVIDIA. And there's also actually some names in there, which I'm very much bullish on. And you also have SK Hynix in there, which as a US retail investor, I don't necessarily have the easiest route to buy that, unless of course I open up an international brokerage and go on their stock market, whatever it is. But right now it would be strategic for me to just kind of go against a contrarian level and start to go, I wouldn't say overweight, but start to head toward a little bit of an overweight allocation toward Omaha. And the reason why, which a lot of you guys are probably attributing to as well, is that if you look at a chart between BRKB or BRKA, if you can buy like 5 or 10 shares, Evan, but whenever that is kind of the inverse of the way the U.S. stock market has been quite some time, because 50% of the weightings in the U.S. stock market are mostly heavy mega cap growth stocks, Amazon, Google, Microsoft, Netflix, and so on. If you have that pullback that everyone's anticipating, you're going to get a lot of move into defensives. Your Coca-Cola, VeriSign, and so on. Maybe not so much VeriSign, but you will get the rotation into defensives, which might be able to give that tailwind for Omaha, because a lot of those holdings, especially in Berkshire, are more focused and concentrated on defensive holdings. Even though, yes, he has $350 billion in cash, he might be deploying, or Warren Buffett or George Abel might be deploying most of that capital in case we have like a massive 30-40% drawdown SP 500 for whatever reason. I mean, I'm a little bit surprised that he didn't really go heavy, or they didn't really go heavy last April, considering that some of the stocks, especially NVIDIA, pulled back considerably from their high and is still a leader in the market. But even so, I think that April was probably a strategic time to go like very overweight, high growth, high tech stocks. Right. And now is not the ideal time on a technical basis, but even we're starting to see a little bit on the earnings basis that some of these companies are coming to earnings with very high expectations. And even though they have a triple beat or a double beat, whatever it is, they could still be sold off the next day, which we saw with Netflix. Netflix is continuing to just print cash every day, the unformidable leader in streaming wars. And they sold off the next day. Why? Because their valuation was quite stretched and the expectations were very high. If you look at the holdings and some of the growth stocks, especially a lot of the ETFs out there, they're more concentrated in what has been the leader for the last 3 months. Now, that's not to say that the bull market's over and it's not going to continue. I personally think we're still at the very early innings of AI. And I know a lot of people on Wall Street say it, but it's probably for a reason, right? A lot of companies spending money hand over fist on getting the compute that they need to meet a demand where the supply is not meeting where the demand's not meeting the supply is not meeting the demand. And I think it's going to continue for several more years. But at this current juncture, especially with seasonality taking place, could be a time to maybe rotate in something more defensive. Take a look at even, I would say, United Healthcare per se, or even other names, or even take a look at Omaha, which I've been looking at lately and been considering starting to add some allocation to it, only because it is a time where I want to create a little bit of cash position and then rotate a little bit more capital back into the growth stocks or the AIS or the wild that has been working for quite some time. Maybe after we get a little bit of weakness in the market and shake off some frothy hands here and some frothy stocks. Because when you see Open Door and you see like very companies that don't even have a revenue trading at egregious valuations for whatever they might be earning in the next few years, it gets a little bit of worrisome at where the edge is, especially when you see the leaders in the market like Robinhood, Palantir, and so on start to pull back a little bit and lose its momentum, which has been leading the upside lately.
It's interesting. What you guys are hitting on is exactly what we're trying to achieve at Vista Shares. We're trying to create products that are, tools for investors in different market cycles. So, we're not going to be everything to everybody, but we're trying to create those tools, but we're trying to do it in a different way. You mentioned AIS, and, I'm a huge AI bull. I mean, full stop. Love it. I think, hundreds of billions of dollars are flowing in. The problem with AI investing is that most AI funds are loading the boat again with these consumer application companies. So you open up the portfolio and you see all these brand name companies in there that are not AI companies. They're the Mag 7 again. So you're buying an AI ETF, and what do you have? You have Meta and Amazon and Microsoft and Apple and all the same exact companies that you have in the S&P 500. You don't need that. You already have it. You probably also own the single stocks as well. You're over concentrated. What AIS does, and maybe we're a little boring, we analyze the supply chain to try to determine where is that CapEx going. So when Meta says they're putting $100 billion into data centers, where is that going? It's going into cooling systems. It's going into fiber optic cable. It's going into racking systems and things like that. Most people don't own Corning. GLW. Corning is the leader in AI fiber optic cable. And that's just one silly example, but that's what AIS is trying to do. It's putting together a portfolio of the picks and shovels, the companies that have the profit pools that are being generated from all this CapEx spending. We can talk more about that, but I just wanted to mention that. But, I agree. Diversification, defensive stocks. I would like to mention QUSA because it's getting a lot of love now. It's a newer product. We launched it in May. OMAH was launched in March. But so while OMAH is a value tilted portfolio, QUSA is a quality tilted portfolio. So what does quality mean? It's just a word, right? It's a descriptive term. But, in financial markets, what quality tilt means, and a tilt is just, it's a fancy way of saying financial metrics that provide certain attributes, right? Or identify certain attributes of companies. So the way quality is defined, and, there's various different ways, but there's some standard definitions, and we use a very standard definition. We're looking for companies that have high profitability, that have low debt, and stable earnings growth. That's it. Very simple. And we do that analysis. We look at the Russell 1000. We score the Russell 1000 based on those three metrics, and the top scoring companies will make it into the portfolio. So these are all companies. And look, we do have some tech names. We've got Oracle in there. Oracle wasn't in the top 10, but as we know, that took a huge run up. So that went to our number one spot. Microsoft has come up as well. But, a lot of these other companies probably are not widely owned by most of your viewers. Illinois Tool Works, right? Cintas, Fastenal. These companies, some of them are big names like Procter and Gamble. But if you go down the list, you've got some names that probably no one's ever even heard of. And that's what we're trying to provide. You got to be diversified, but you don't want to be blindly diversified. You want to make sure that there's a rationale to how you are diversifying your portfolio. QUSA, so it's basically the same product as OMAH. It's just a different equity portfolio. The only two overlapping securities are MasterCard and Visa, which they're both portfolios have. And QUSA also has that 15% income target annually, with a 1.25% target per month. And we just paid that out again, today actually as well. So, and again, why do we do 15%? Why are we doing 1.25? Again, maybe we're a little boring, but we're not trying to, squeeze every dime of income out of the portfolio every month and put up these monstrous numbers. What we're trying to do is provide stable, consistent income that people can rely on every single month. Now, I can't promise that we're going to be able to do it every month because you can't promise anything in life, right? But that is, we have target 15 in the name of these products, and that is by design because that is what we're targeting. And, our goal is at 1.25% per month, not 1.26, not 1.24. We want to hit that 125 so everyone knows that on Tuesday, every month, on the same date, they're, once a month, they're going to get their payment.
Could you speak to, I was kind of asking you before we started the live stream, but unit creations and what it's looked like for QUSA and what that means?
Yeah, I mean, it's a smaller product. Again, we launched it in May. It was around 12 million, and we've gotten, I think, 6 creation units over the last 2 trading days, which is nice. I mean, so the average volume has gone up, from 15, 20,000 a day. Now today, I think we did close to 50,000 shares. So that one is definitely taking hold. And I anticipate that by the end of the year, I don't know if it's going to be the same size as OMAH, but I anticipate it will, because what we're seeing in the institutional market, and when I say institutions, I'm talking more RAs and family offices, right? They are really drawn to the quality tilt. Quality investing is one of the most the largest asset areas in ETFs. So if you look at all the tilts, so if you look at, value obviously is huge, quality, low volatility, and momentum. Those are kind of the four big ones. And quality is, if you look at like the iShares factor ETFs, they have the largest suite of factor ETFs. Quality has the most assets, always, in all market conditions, and it's growing. So, that's what investors are looking for. They want a quality portfolio of safe companies that are growing consistently over time, that have profitability and low debt. And that's what we're providing, but we're doing it with the 15% overlay.
Evan, any thoughts on QSA? I know you're a big America guy.
Yeah, no, I was just I was shocked by your implicit claims earlier.
Okay,
No, I was
it's
gonna
like
no.
telling me, hey, take 4 things that you love and tell me which one's the worst, What do you want me to do?
I think it sparks good conversation, and one man's. There are 3 different general baskets of themes we have going on here: the kind of 15% income, the 2x, and then the AI theme. So it's natural that one of those baskets they'll tilt more to be a fan of, and when you're not. So that and I think that goes to what you were saying, Adam. Of we want stuff to kind of be able to work in every single different market. And that question I asked you, it's all about you and the time frames and stuff, because you said 10,000 and Sam said 10 million. If I say 10 million, I'm definitely leaning more towards the OMAH and the QUSA than the 10,000. That person probably is more likely to lean towards the wild. Maybe not always. Maybe it's the whatever, but you kind of like it's and time frame and everything. So I thought you answered that question in a good way.
Yeah, well, look, wild is a whole different type of product. It's a whole, this is not a core product. It is a product to express your view, to drive alpha into your portfolio, right? So everyone, a lot of people are using those XX levered single stock ETFs, and they're driving billions and billions of dollars. I personally don't use them. And the only reason is because I'm a horrible stock picker. I mean, if I'm going to pick a single stock, I'm going to get it wrong, or maybe I'll get it right, but I'll buy it on the wrong day. I'll buy it on the day it goes down 10%. I'll get my face ripped off. I mean, that's just, that's my lack of skills on that. So what we did here is we went into the institutional market. We talked to institutional trading desks, and we said, all right, guys, what's going on with these single stock ETFs? How do your institutional clients get exposure to high beta stocks? And they were in unison. They had different systematic approaches to do this, but they were picking baskets of them. So the institutional players want the high beta alpha potential, but they don't want to pick just Tesla, because if they're wrong, they're really wrong. They want 5 or 10 or whatever the number is, depending on the institution. So what we simply did is say, that's an interesting approach. Let's take an institutional approach to providing this to a broader market. So what we simply do is we look at the ETFs in the market. We look at all the 2X ETFs that are single stocks, and we look at their fund flows. And we're trying to identify where the investor sentiment is strongest. So, and how do you do that? Where are the dollars going? Where are the investments going? That's how you understand, where investors are interested, right? So we're looking at the XX levered ETFs, we're looking at the fund flows, and we're identifying, which ones are growing the fastest in AUM and which ones have the most AUM. And then we have a scoring system, the systematic scoring system. We put 60% of our score on the fastest growing names and 40% on the biggest names in terms of assets. And we rotate them monthly. So every single month, you're getting somewhat of a different portfolio. There could be holdovers like there was this month, but you're going to get some changes because investor sentiment changes quickly, and you need to stay ahead of it. So if we have Tesla, which we have in the portfolio now, if Tesla's up 30% one day, we're not going to rip up as much as if we just own Tesla in the portfolio. But guess what? When Tesla's down 10%, we're not going to go down as much either. So it's a little more diversified. I wouldn't say safer, because there's nothing safe in investing. You have to, do your due diligence and do a lot of research. But it's a more diversified approach to, kind of high alpha opportunities.
I will be honest, it is up more than I thought it was.
Mhm.
I didn't realize how hard this ripped this week. Wild now up over 20% since inception, over 30% from Adam, our first live stream that we did the day that it launched, where it was down 10%, right? Its first day. And it is just absolutely ripped since there. So yeah, shout out to anyone that I remember being on live. It's recorded, trading at about 17:30, and now it's trading at 24:30. So that is a nice jump right there. So yeah, this, like you said, this is definitely more of that leverage play. But it's funny because it's I guess it's not an oxymoron to say diversified leverage. There's just not a lot that you see like this, especially concentrated still to about 5 names. I did see it's trickling up a little bit on the UM. I saw the volume was a little bit higher today, 6,000 or so shares on this. What do you think needs to happen here for this to really pick up steam?
I think people need to understand what it is and how it works. It's so easy to understand what a double X leverage Tesla product is, right? It's a double X Tesla, right? So when we launched it on June 4th, I think it was June 4th, that was the day that Tesla or Elon Musk got into a big fight with Trump and Tesla huge dive. So that was the day we launched. So, but yeah, I mean, look, the word's getting out. Certainly the performance speaks for itself. If performance continues over the next 6 months and a year, people are going to migrate to it. Performance wins at the end of the day. But I think, people just need to understand what it is. So we need to do a better job of communicating what the product is and how it works. It's 5 stocks, rotated monthly, 2x levered. That's it. It's very simple. We're picking the highest conviction 5 stocks based on where investors are putting their money.
Yeah, it's pretty fascinating to me. Sam, you got any thoughts or questions on this area?
Yeah, how do you create the 2 times leverage with the ETF? Do you guys use call debit spreads or?
We're using swaps. We're using swaps, which
okay.
is mostly what these 2x leverage products are doing. Some of them are starting to migrate into some options only when they need don't have the capacity on the swaps. The swaps are traditionally just a little more easy. They're cheaper as well.
You do it on a daily basis, right?
We reset daily, right? So it's the leverage is set back daily, and the allocation. So it's 5 stocks equally weighted. So we set that back to equal weighted every single day.
Evan, any thoughts there?
No, yeah, that is very in line with how all of those 2x ETFs end up going. We're at an interesting point now where when for a long time it was these are for traders, and still they kind of are. But I wonder how stuff starts to change. I've heard those whispers of, hey, this is a leveraged ETF, more made for holding a little bit longer term. There's been 1 or 2 of that have been able to get. I know there's certain language with those leveraged ETFs that you have to have in, like this is for trading devices or something, or this is like whatever it is. And I think they were able to get through, or like this is not meant to be held through the day or something. I think that disclosure might be in there, right?
Yeah, there's a lot of disclosures with the leverage.
I think there was. I heard someone say, "Hey, we were able to get it through without it saying this. You can only hold it, like it's only meant to be held for the day."
Yeah.
So I wonder as we go in and as this new genre expands. But one thing I've seen in general with ETFs and Atom and Vista shares are definitely a part of this is there's a lot of innovation happening quickly, and truthfully, they're getting rewarded pretty quickly too. Some of these ETF AUMs are flying pretty quickly. So you innovate, you find a new spot, you get rewarded for it. Then we tend to see an expansion of that theme within that company, and then 75 other people. And then the smart people like Adam and a couple other people out there go find that next theme. And then the same thing happens again. And there's no with the 15% one, I feel like is that one. Expect to see that grow. Expect to see 10%. Expect to see 20% from all these other companies in there. But OMAH, QUSA. I feel like that seems to be the theme. If I was going to rank them, I would maybe put AIS on top, truthfully. It depends on what perspective we're talking about here. I've been fighting through the rest of them. I'm going to do it. Let's do QUSA second, OMAH third, and I'm going to put the Wild fourth. And it's I don't know. We'll leave it there.
Wow, Evan, you really must hate that ETF, huh?
I know, right?
These are my babies. You can't diss on my babies.
Making it last.
I really the AIS theme. Yeah, listen, we might get a pullback, but just my general thoughts of where it is, and if AI is as big as everyone thinks it is, where we are in that bigger scheme of it, it feels like AIS, the picks and shovels within that, really like this underlying data center theme, is something that I really want to be exposed to over the next couple of years. So
Yeah.
to me, that's the one that excites me the most.
I
Honestly.
tell you, just over the last 4 trading days, AIS has, I think, 8 creation units or something. So that product was languishing.
What is a creation unit? What does that mean?
So a creation unit is how ETFs grow assets. So the market makers sell shares into the marketplace. They go short. Once they're short a certain number of shares, it depends what the creation unit size is. It could be 20,000, it could be 25,000 shares, or other numbers as well, depending on what the ETF issuer chooses based on the product. Then they create a unit. The unit is a block of shares. And that's when they create is when you get the assets. So for instance, AIS, I think it's a 25,000 share block. So every time a market maker, goes short 25,000 shares, 50,000 shares, they'll create a unit or 2 units of shares. And that's when our assets increase in size. So that's how you grow an ETF, and it's the mechanics behind it. And AIS, I think, has doubled in the last 2 weeks in size. So it's still small. It's a tough market. There's a lot of product out there, but now people are starting to say, wait a minute, this is totally different than the other products, and the performance is killer. So it's around 30 million right now. Well, after today's creations clear, it'll be around 30 million.
I would like to talk about AIS for a second and basically just double down on what you've been sharing. But the reason why I'm pretty bullish on this one as well. And one thing I was reading yesterday is that AI is someone was saying a $80 trillion economy. I don't know, some crazy number. But basically, the idea was that there is so much that can be accomplished here in this world of AI. And obviously, people do gravitate towards NVIDIA and AMD and other names like that. But the whole goal here for AIS is to target the underappreciated names in addition to those. So, you're not getting no exposure to NVIDIA. You're getting that 5%. TSM, right, is up here. And these were smaller pieces of this beforehand. They've grown. But I want to walk through some of these other names. And Sam hit on it as well, right? SK Hynix. People should go look up the chart for SK Hynix and see how good this looks. But you can't buy it on Robinhood. You can't buy it on a lot of the US brokerages, right? So you're just not going to have it. Same thing, I believe there was for another name that's been circling through that I've seen a couple of times on here. I just don't think people are going to find it. Maybe it was Legrand, right? There's just some options on here that I don't think most people are going to go and find at the moment. Now, there's also some that I think just get overlooked. Marvell. I don't think people realized how good the Marvell, chart was actually looking. What's it called, especially these last few months. Now, obviously you had the drop here, but then look from here. You move from 45, 47 to 80. I mean, it almost doubled during this time period, right? That last 3 month time period. And I just don't know if people would have necessarily caught that. And I think that a couple of these other names also really stand out. Now, obviously, GE Vernova is one that you've hammered on this show, over and over and over. And it's still something that I don't know if it's, come in to people's mindsets the way that it really should with GEV. Like I've talked to on this call over and over. I mean, coming off of earnings as well. Like, look at how good this thing's doing, right? Especially over these last several months. It's up over 100% in the last 3.5 months. So there's names in here that are going under the radar because they aren't NVIDIA, right? They aren't some of these other names, but they are really powerful. And the picks have leaned together, and that's how you're getting this return. 30% over the last 3 months, very competitive, way outpacing SPY, QQQ, but doing it with no single holding having over 5.5% weighting. That's the impressive part here, right? It's one thing if you have a portfolio where you have a name in it that's a 30 or 40% holding that goes up 100%, right? And then you get this. But right now you're looking at a portfolio that is very diversified. Look at the amount of percentages in these names, and it still has moved an incredible amount during that time period. But the reason that it's not going to end is because these names, like you mentioned, are the picks and shovels place. They are not there to be the top of the ladder. The idea is what's building it out. And you showed me some amazing research. And I think, Adam, people can find it on this website as well, right?
Yes, we have. We in the insights section, we have a bunch of content. We've got our presentation, our investment case. There's a white paper at the bottom of the ETF page. There's a white paper for AIS as well that goes.
Yeah, where's that?
At the bottom of the.
Here.
Yeah, well, not that far down.
All right, let's go white paper.
There it is.
All right. So I believe that this one, and I'm going to show you this tab. So there's a couple of graphs that I've looked through and things that Adam's basically put together, but essentially going in and deeply tracking, right, all of the picks and shovels. Where is the coolant coming from? Where are the semis coming from, right? And just having all these pieces, finding the names that people wouldn't think, oh, wow, like you're the pinnacle supplier that led to this happening. Let's add you to the piece, to this package, to this ETF. And that's what's coming together. So by the way, great graphics on here. I hadn't even honestly I haven't seen some of these before.
Wait,
I think
where are we? Where are we looking here? Where are we looking here? Is this the fact sheet?
You
This
can't
presentation?
see this?
No, I'm trying to ask, where is this?
Oh, that's the white paper at the bottom of below the performance area of the ETF page.
Yeah, it is in the fact sheet. I actually, what I'd been reading was a lot more like rudimentary graphs. So I do encourage people to just go look at this, because this puts it together a little bit easier for people to see than I was going to. But
And look, I mean, go on, Evan.
No, sorry, that wasn't me.
Yeah, I was just saying, I'm almost embarrassed NVIDIA's number 1 now, but that thing is ripped. It was number 16 in our portfolio at rebalance on 630. So that is just
right. And we haven't even mentioned it, but the investment committee of who's picking for AIS probably doesn't hurt, right? So people might be thinking, well, who's actually making some of these picks? Well, let's talk about it for a second before we do wrap up here, because you've got a few very, very capable people who are making these picks. So I just want to highlight John McNeil. I wonder if the former president of Tesla knows a thing or two about AI. Probably, right? Grew revenue from 2 billion to 20 billion in 30 months there. Shout out. Was at Lyft, serial entrepreneur, bunch of advisory positions. John's on the investment committee helping to make these picks that we're talking about. How about Sunny Madra, right? Shout out. Well, actually is what's it called? He's the president at Grok, right?
Yep.
Is that correct?
Yep.
Yeah, president at Grok, GROQ, huge AI company here. So you have people who have, people probably would pay thousands of dollars an hour to just pick their brains on this stuff, and you could just buy the ETF. And so it's like, all right.
Can I ask a question? So what I got on the screen right now, what would be the correct way to like word this tweet? Is it like the cost? Here's how much it would cost, or what does BOM mean?
Bill of materials. So what we do is we analyze the supply chain. We break out all the components of the supply chain for the data centers and for the semiconductors. Then we analyze what each level of the supply chain costs as a percent of total. So for data centers, for instance, how much does cooling systems cost as part of a data center? How much does racks cost? How much does fiber optic cable? We layer that in. So that's what the bill of materials is. So we're weighting the companies based on their importance within the actual build cost of the data centers and the semiconductors. It's just, it's a very novel way of looking at it. And we think it's a very, way to get pure exposure.
This is literally stealing my alpha. Like, I'm not saying you're stealing my alpha, but it took me months and years of research to basically get the top names on this list. The problem is figuring out which one to buy. As a retail investor myself, I like diversification, but if I'm trying to seriously outperform the market, I need to be more concentrated. However, for someone who doesn't want to put in the effort that I've put into it, these are really names that I would have picked. You were mentioning Marvell Technology. A lot of people didn't know that they helped Amazon or AWS design the Trainium and the Inferentia chips that are basically high margins for them. And a lot of people don't know that they help design the chips for a lot of the mega cap companies and hyperscalers as well. But you already have it here as like 2 or 3% concentration. I forget the exact number that's on there. And you're able to prove it and back it by the amount of money that's being spent on data centers for the picks and shovel plays. that's remarkable that you're able to provide this data, because if I go back in time and I had this white sheet, then that would have saved me a lot of time for sure. But definitely, I mean, it seems like a very solid ETF, and you have a lot of backing with the facts on there, determining how much the budgeting is going toward. And it's really interesting seeing Nutanix on there, because a lot of people don't even know what that company is. But of course, if you're in the data center realm, then you do know. And Vertiv Holdings, like a lot of people really turned off by the fact that that was a SPAC at some point, right back in 2021, and people have that distaste in their mouth with like the way SPACs have happened. But you know, just because it's a SPAC, it doesn't mean that it's necessarily a bad company. It just got a lot of exposure, ran pretty hard in 2021, and then people kind of dismiss it. But then when you look at the research, even from what other companies do provide, Vertiv Holdings is one of the top holdings in a lot of their split ETFs that they do have available to clients. And seeing this on yours, and probably going to be an outperformer in the next few years, in my opinion, which I'm actually looking to get into that one. I just haven't found the ideal time to get into it. But at this point in the market, it definitely, the alpha in the market is definitely narrowing. You know, not everything's running up like it did in 2023 and 2024, and even like in April and May. Things are narrowing where you have your picks and shovels that used to be like great plays are not necessarily the great plays anymore, because the strategy that a lot of the CIOs and companies are doing is that they want the best of the best products and the best of breed. So they're not going to buy everything and whatever works. And that AI narrative that has really been pushing the costs and the spending that companies have been doing back in 2023 are now, you know, let's cut the head count, let's make things more efficient, and let's start to narrow down and consolidate who our vendors are. And you have a lot of the leaders here that are those vendors that they consolidated into. So pretty good to see this here. And I'm going to check out that white paper actually. That was some really cool graphics there, some real cool stuff.
Yeah, please do. I mean, I love Vertiv. Vertiv is actually, I think, one of my favorite companies because, you know, going back to the bill of materials, who would think that about 30% of the cost of an AI data center is in cooling systems? Actually, and so that's a big number. So when you're talking about hundreds of billions of dollars being deployed to build data centers, 30% of that's going to cooling systems. Who's the leader in cooling systems? Vertiv. So it's there, and that's how we do how we build a portfolio. You know, you mentioned GE Vernova, and that was a company that Sonny was banging the table on, you know, a couple months ago. And the reason being is because we all know that there's a energy problem to power these AI data centers. So what are they doing? They're putting their own power generation facilities on the campus with the data centers. So, and a lot of those are actually natural gas driven or powered generation systems. We have plenty of natural gas, but guess what? We don't have turbines. Who builds the turbines? GEV. So, I mean, it's all, every single company in there has a similar story. And this is what we talk about on our investment committee. And frankly, God, to your point, I mean, sitting on a call with you know, John and Sonny as they're bantering about the supply chains. I mean, John is also vice chairman of the autonomous vehicle division at General Motors. Yeah. And, you know, we see what they're doing over at General Motors on autonomous vehicles. So, you know, these guys know the space, they know the supply chain, they know the technologies, they know who's winning, they know who's losing, and they could see down into the future because that's their job. You know, and it's pretty amazing to hear them talk about these things. So I'm scribbling notes, and then I take the notes back to Professor Whitelaw, who is the former dean of NYU Stern School of Business, and he and I try to express their views into the portfolio and keeping the risk metrics, you know, similar in the portfolio.
I love it.
I got a question for you. Are you using any of those like AI meeting recording things? I am half joking. I'm not joking at all.
We do.
Share the notes with us.
Good.
I can't
Those
keep up
things are awesome.
otherwise. Yeah, they are.
I want you to take the last 15 hours of meetings with them, feed that into Perplexity, and tell it to basically, you know, project what this portfolio is going to look like in 1 year.
Oh,
and I want to see what it looks like.
That would be interesting. That would be interesting for sure. So
yeah.
No, it's fun. It's very fun. And that's why we got into this business. John was looking for an AI ETF. That's how it all started. He wanted an AI ETF. He was on CNBC and he said, oh, there's got to be an AI ETF out there. It's good. He looked at all of them. He said, these aren't AI ETFs. These are Mag 7 ETFs. And that's how, you know, he decided he wanted to get into ETF market. And that's how we got together and partnered. And here we are.
Yeah. I mean, the performance is awesome. The last month, 5.5%. It's great. All right. Always a fun time hanging out with you, Adam. Anything else you want to make sure we get in here before we wrap up?
No, I appreciate you guys, appreciate your time, appreciate your viewers, and all the support we've gotten in the market. I mean, we're about to break 500 million total assets as a company, which is incredible. We've only been selling for 7 months, or we've really been in the market for about 7 months now. So very rapid growth, and very proud, very humbled by it. And follow me on X. We try to put out a bunch of educational materials as much as possible. And I'm always available for questions. And I just appreciate all your support.
We love it. Sam, thank you for coming on for this episode. Any comments from you?
No, I mean, this gives like really good research. Just look at this white paper. Definitely going to check it out. I don't know. Maybe we could do this over at the headquarters of Grok next time. I don't know. Just throwing that out there. But send us those notes. Seriously.
Can we get to a data center? I've honestly been trying to do this. We will make some really good content. I will give me an AIS shirt, a hat. I will make everyone who goes there. You need to have at least 4 pieces of AIS merch to get in the building.
I love it.
I've been to a data center before, and I don't think you could do anything in there. It is so much security. Those days, like there are people you got to go. It's worse than walking
too. I
into,
mean, these are
yeah,
right?
it's loud, but also it's like the security in those places are so locked down.
Yeah,
but that'll be awesome.
We got to get Sonny on one of these live streams. I know we had John on one.
Yeah,
maybe Sonny.
Yeah, maybe we could do that. I could work on that.
Drop us on an email chain. We'll schedule like a month out. We'll give him plenty of time.
All right. I'll work on it.
Awesome. Evan, any other comments?
Get me into a data center. No, I'm kidding. But no, I'm working on how I can word this post. But I really like this data center one.
It's good stuff. I like that one as well.
AIS, the AI infrastructure ETF.
Yeah, just to recap, 4 ETFs: QUSA, WILD, WILD, OMA, OMAH, and AIS. That's going to do it for this stream. Thank you to everyone who tuned in. We appreciate y'all. We had 7,642 of y'all on this one. Gotta love it. We will be back tomorrow with more spaces. Tomorrow, by the way, before people go, is kind of like the Super Bowl of investing. I don't know if people have seen what's happening tomorrow. We have not only a ton of major earnings that are going to be happening with Microsoft, Meta, Robinhood, Qualcomm, ARM, Grab, TMDX, Carvana, Lam Research, Ford, and so many others that are happening tomorrow. It is also an FOMC meeting day. It is also, I believe, Trump is finalizing some stuff on crypto bills is happening tomorrow. There's a couple other giant macro things. There's data that's going to be coming out, I'm pretty sure, in the morning. So there's just a lot to be aware of going into tomorrow. So don't blink. It's going to come at you fast. It's going to be a crazy day in the market tomorrow. And tune in on Spaces. We will cover all of it. Thanks, everyone. Appreciate you as always. We'll